Good afternoon and welcome to Equity and Ag, your daily recap of the stock market and agricultural futures. Let's break down what's moving the grain and livestock markets today. Corn futures pulled back on Tuesday, snapping a short two-day winning streak. March corn dropped 5.5 cents to close at $4.26 May futures fell 6.25 cents to $4.35 There was not much fresh fundamental news driving the move. From a technical standpoint, March corn slipped below near-term trendline support at $4.30. The next key support level sits near $4.25. If that level fails, traders could start targeting the January lows below $4.20. On the demand side, export inspections remain extremely strong. For the week ending February 12th, nearly 58.8 million bushels of corn were inspected. That brings total inspections to approximately 1.4 billion bushels so far this marketing year, about 44% ahead of where we were at this time last year. Even with last week's 100 million bushel reduction to United States ending stocks, overall supply remains historically large, still the biggest in roughly 7 years. Looking ahead, traders will begin focusing more heavily on next year's crop projections. The USDA Agricultural Outlook Forum later this week will offer the first early estimates for the next marketing year, which could start influencing new crop pricing. Soybeans managed a modest recovery on Tuesday. March soybeans gained 1 cent to close at $11.34. May futures were up 1/4 cent to $11.4875. The market bounced back from overnight weakness, supported by stronger-than-expected January crush data. Even though the recent February rally has slowed, price dips below $11.30 have continued to attract buyers. Export inspections for the week came in at 44.2 million bushels. While that was slightly above the previous week and stronger than the same week last year, total inspections for the marketing year are still about 32% lower than last year's pace. The USDA currently expects soybean exports to decline roughly 16% year over year. On the processing side, demand remains impressive. NOPA reported that its members crushed approximately 221.6 million bushels in January, a record for that month. That suggests total January crush likely reached around 226 million bushels. Overall, crush pace is running more than 7% ahead of last year through the first 5 months of the marketing year. However, soybean oil faced pressure after reports showed oil stocks sitting about 49% higher than a year ago, which caused futures to reverse earlier gains. Wheat markets were weaker across the board. March Kansas City wheat fell 3.75 cents to $5.3875. Chicago futures saw larger losses, while Minneapolis futures also traded lower. Two separate agencies raised their forecasts for Russia's 2026 wheat crop, which added pressure to the market. Technically, March Kansas City wheat appears headed for another test of trendline support, near $5.30, a level that has held multiple times in recent weeks. Export inspections came in at 13.8 million bushels, down from the previous week but still ahead of last year's pace. So far this marketing year, wheat inspections are running about 19% above last year. The USDA currently forecasts wheat exports to rise roughly 9% next year compared to this year. Weather also played a role. Some rainfall is expected across portions of United States winter wheat country. While coverage may be light in parts of the central and southern plains, eastern soft red wheat and Pacific Northwest regions could see some drought relief. That likely contributed to the heavier selling pressure in Chicago wheat compared to Kansas City. In the livestock markets, feeder cattle sold steady to as much as $5 higher compared to last week. In some cases, especially mid to lighter weight cattle suitable for grazing, prices were sharply higher. Markets appeared calmer this week after Winter Storm Fern disrupted trading and transportation across large areas of the country. With weather conditions improving, supply increased as producers who were previously unable to move cattle brought them to market. Despite the heavier supply, optimism remains strong among feeder cattle producers and cattle feeders. Sentiment across the cattle complex continues to lean positive. Disclaimer: this report is for informational and educational purposes only and should not be considered financial or investment advice. Trading futures, options, stocks, and commodities involves substantial risk and is not suitable for every investor. You can lose more than your initial investment. Always conduct your own research and consult with a licensed financial professional before making any trading or investment decisions.